Hi, everyone. This is Dr. Duru from the Market Breadth writing at 122, which is what you're looking at here is my financial blog. It looks like once again, the headlines that I wrote have accurately described the general technical setup. And I just wanted to go through now that the market weakness is obvious, what to do now. So I want to go through what to do now that it's pretty much obvious, or at least it should be obvious to everyone, that the fundamental nature of the stock market is weakening or it is weak. All right, so let's take a look at what I mean. And you can read more details at this blog post. You can see the URL right here. So what do I mean? Well, let's first, actually, I don't want to look at NVIDIA just yet. Let's first take a look at the volatility index, sometimes called the fear gauge, which is the VIX. Now, let's look at a few features here. All year long, the VIX has essentially, with just one blip back in March, has had an uptrend, but it hasn't been so obvious because it's been very slow and subtle. You can see these higher lows and higher highs, but the faders, what I like to call the faders, have successfully faded the VIX. Every time it comes up, it makes a new high, fades it very quickly, makes it look like everything is just fine all over again. What happened differently this time around, and this is what I wrote about earlier, was that the VIX was finally showing some resilience in this area. And last week's highest close of the year, and then today's close, is something that the VIX has been unable to do all year long, which is to hold high levels despite even some fades in between. So the VIX is in full effect. And of course, the higher it goes, the more stretched the bearish sentiment gets. So what to do now? Well, if you're just now recognizing the market's weak, know that it is actually kind of late in the fear cycle. And I know that's hard to believe because the indices are very high up. So let's take a look at that. Why the weakness is so obvious to so many now. Well, here's the S&P 500, and you can see right away that the uptrend is done. That's the 20-day moving average. It's broken through. It first broke through back on April 4th. And of course, the mechanical rebound happened right away to make people think that the market was just going right back to normal, but it never really did. You could see it never really quite confirmed this breakout with two higher closes. So I was seeing a downtrend starting to develop. Last week, once again, let me zoom in so you can see it. There was a mechanical bounce right off the 50-day moving average, which is this red line. And, these things are just mechanical. Sometimes technicals just work that way. And today, the mechanical move was, hey, buyers stepped right in for whatever reason. They gapped up the market and got as high as this level, which was almost the intraday high from Friday. But then sellers jumped right in and took advantage of the higher ticks and sold, 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 sold. And now the 50-day moving average is broken. And of course, lots of people are talking about that. Yes, it's a bearish signal. It's not confirmed until there's a lower close, but still, this looks ugly. It should be very clear to everyone that this long uptrend that we've enjoyed is in big time trouble. And if anything, this is probably topped out for some time, no matter what kind of bounce or rebound we get, whether it's technical or whatnot. The NASDAQ, same deal. It's broken through the 50-day moving average. It closed at what is this? Pretty much almost near 2-month low. Now, its downtrend from the highs is not so obvious. And in fact, the NASDAQ until today's close was really just kind of churning along. And it was hard to actually see that. And some folks, I'm sure, assumed that all was well. But really, the NASDAQ has just been churning along, even despite getting this new closing all-time high just last week. So it could look like that the selling and the fear cycle is in its early stages because, of course, the market is still substantially up since the beginning of the year. It's hard to tell. I'm not making any predictions. You should do your own analyses and trade and invest according to your own risk tolerances. I'm just giving my observations for educational benefits. But from a price level standpoint, it looks early, but from a technical standpoint, things are already kind of stretched. So you have to expect a rebound at any time. I would prefer to fade a bounce. I have some shorts in place. I would prefer to fade bounces from here. And I am closing up and taking some profits now just to make sure that I at least get out of this episode having locked in some gains. Now let's take a look at the ETF for small caps. It actually is in even more trouble. Last Friday, it confirmed the 50-day moving average breakdown. And then today it stretched down and looks like it wants to test the bear market line. Now, as a hedge, I did buy some call options on Friday and I did some more today. Looks like those will probably go to the waste bin, but that's all good because I wanted to hedge some of my short positions and puts. All right. So let's go to my favorite technical indicator, which is the percentage of stocks trading above their 50-day moving averages, what I like to call AT50. I've written about, this is the core technical indicator that I write about. And I wrote about, my skepticism about this rally once, particularly after my AT50 could not quite test the overbought trading level. And according to my trading rules, it's actually on this rejection here, that's the time to get bearish. Now, the market did not quite confirm or follow along with the bearishness. So, I had to keep waiting and waiting and waiting. And finally, the true signal came at the beginning of trading, sorry, on Wednesday, April 10th, when market breadth totally gapped down. And that's when I finally started to get more aggressive, going short and buying put options. And now, we're overstretched to the downside on market breadth. You can see we were starting to get stretched on Friday, and now we're very stretched today. What do I mean by stretched? Well, this Bollinger Band that defines sort of the 80% of the movement or the trading action has now been punctured twice, and this market breadth is getting further and further away from that line. So again, what to do now that it's obvious that the market is weak to everybody? Well, you're going to have, if you want to be short, if you want to be bearish, you're going to just have to position yourself properly to anticipate and be resilient against any kind of snapback. At this point, now the market was looking for any kind of headline, and we got it in geopolitics to have an excuse for selling. Now the market may be looking for any excuse just to buy. And as I showed you with the S&P 500, somehow people came up with an excuse to buy right at the open, and of course that got faded. In my blog, I did warn about that, and I claimed that move, any such move, wouldn't last the week. It didn't even last a few hours, I think. Okay, so that's all fine and good for the technicals. I want to also just wrap this up with an individual stock that I'm tracking over, very closely because I think NVIDIA holds the fate of the market, given how much of a darling it's been and how well it's performed. I've written about this. I've done videos about this where NVIDIA showed a topping pattern. Sorry, I don't have all of my indicators and labels, but this was a major topping pattern. NVIDIA has never invalidated it despite having made some new closing all-time highs, and now it's under its 20-day moving average. That's the next bearish step. It actually did confirm the topping pattern here, but that rebound really quickly didn't give a chance to really firm bearish opinion. And then once again, it just barely confirmed that topping pattern and then bounced right back. So these I consider to be automatic or technical rebounds. There are programs out there, the people who see the downticks and think it's an automatic buying opportunity. I am, of course, looking for a buying opportunity to get into NVIDIA, so I'm probably like the majority of folks. But anyway, having said all that, I'm watching this very closely because it looks like NVIDIA will test its 50-day moving average, which again is this red line, at some point soon, even if it's the average coming up to meet price. And then I'm really going to be watching to see whether that test holds. Again, because NVIDIA acts so mechanically and technically and automatically, I expect it to bounce after it hits that support. So what's key is what happens after that test. Does price action hold? Can it get back above the 20-day moving average, or does it break down and then do a confirmed breakdown with a second lower close? These are the questions that are now in front of folks now that, again, it is obvious and clear that the market is weakening, or depending on your perspective, the market is weak. Let me go back one more time to my favorite technical indicator, AT50, the percent of stocks trading above their 50-day moving average, I forgot to point out that for me, the true buying opportunity is when stocks get oversold. Sorry, let me pull that over. And that's when only 20% of stocks are trading above their 50-day moving averages. Now, this is going to be this is going to be, I don't know how fast this will happen. It could happen as fast as this week. And if the selling continues, surely it will happen next week. And then once we finally get into oversold territory, and I think we're way overdue for this kind of trading cycle, then I kick in my oversold trading rules, which now I flip bullish, or at least cautiously bullish, depending upon how the VIX is acting. And then, of course, my thinking and my trading completely reverses from what it is now. Now, the VIX, like I said, is already stretched. Let's just take another quick look. The VIX is already stretched to the upside, and market breadth is stretched to the downside. So this is what I call a quasi oversold condition, meaning that we have 50-day moving average breakdowns, we have market breadth falling, and we have the VIX increasing. All of that is stretched at trading action. So again, if you want to be bearish, if you want to be shorting things and buying puts, you just have to brace yourself. There could be a snapback at any time. But now the momentum is flipped in the bear's favor. So over time, I think we are heading to this oversold line. Now, again, I can't make predictions. I can't make projections. This is just the expectation that's going to formulate or form the basis, sorry, of my trading. Again, not a prediction, not a projection. It's just the guideline. And of course, things I have to change if conditions change. So if you have any questions on that, put your comments in the chat. Otherwise, subscribe to my blog. I'll be writing more about this stuff, of course. And you can also subscribe to this YouTube channel. So in the meantime, thank you for checking me out, and I will see you again soon. Take it easy.